Welcome to all of you who have signed into this webinar for the second course in our professional certificate program, which is concluding effective today: money and debt markets, concepts, instruments, risks and derivatives. Let me introduce you to the team who are here today. This is Ranjita Shastri, who's one of the research assistants helping me with this course. The second research assistant, Divya Parikh, was not able to be here at the venue today, but she, like all of you, is watching this webinar from the comfort of her home. How lucky. And then there's Yusuf, the person behind the camera, and the resources from Link Street who are helping us take it to the desktops wherever you may be in the world, right? So that's a brief introduction about myself. I'm sure you got fed up of seeing me in the videos. I'm PC Narayan, the course instructor for this course and several other courses to follow in this professional certificate program. What we've done is taken some of the questions that you've posted on the discussion board, or specifically for the purpose of this webinar, and I will take them one by one. So here's the first one. Savik has asked a question: how does the government's borrowing calendar impact the short-term as well as the long-term bond market? Now, as I mentioned in the course, government is the biggest borrower in any country, and therefore they must state upfront how much are they going to borrow, when are they going to borrow during the financial year. That will give the markets the opportunity to make sure that they mobilize the funds that are needed in case they want to invest in that new issue of government securities or treasury bonds. So the government always comes up with that borrowing program. It's usually announced in advance, and as I said, which gives enough time for prospective investors in government securities to mobilize the funds to invest in those government securities. Such a planned approach will ensure minimum volatilities in interest rates, both short term and long term. Because remember, if the government just comes up one fine day and says, right, we're going to borrow X billion dollars, people who go to bid for it have to raise the resources, and therefore there will be a liquidity crunch in the short term market. And what you will also find that because of a parallel shift in the yield curve, the long term yields would also be most likely impacted. What does happen though is, while the government with the best of intentions might give this borrowing calendar, there could be several inflection points during the year when there will be a sudden need for them to do some unplanned borrowing, or sometimes shift the borrowing calendar away from what they had said they would at the start of the year. This would usually happen, for example, as the year progresses. Let's say the government's fiscal deficit went up, and a good example of this is, for instance, oil prices go through the roof. The government's cost of importing oil goes up, which means it needs more financial resources, which it doesn't have ready to hand, and therefore it has to borrow more. So these are generally exogenous variables. That means circumstances which are outside the control of the government. Well-run governments stick to the borrowing plan most of the time, almost 90% of the time. Now, any event that's going to impact the fiscal deficit that they said they will hit during the year, and normally fiscal deficit, as some of you will be aware, is how much excess borrowing the government is doing vis-a-vis the revenue that it is earning. Now, what are the revenues that any government earns? Taxes, indirect taxes, direct taxes, value added tax, corporate tax. There are several sources of taxation through which the government earns its revenue. And the expenditure is all about spending on infrastructure, spending on government employees, their salaries and payroll and what have you, and in some countries, for instance, to provide subsidies for some schemes which the government said it will fund partially. That's a subsidy. Now, these are planned for. Whenever there is an unplanned event, the government will end up suddenly having to raise more debt, and that could create a tizzy in the market. Interestingly, when the government is mulling additional borrowing, the markets, and that's the beauty of free markets, markets have already sensed it. And so what happens is, interest rates already start going up much before the government has even announced that it's going to increase its borrowing program. The same would be true alternate. Government might suddenly come in and say, we are reducing our borrowing program for the year. In fact, the country where I live, India, this happened just a few weeks ago. India's financial year runs from April of a year through 31st March of the next year. So September 30th is the half year. A week before we hit the half year deadline, the government said, over the next 3 months we are going to borrow less than what we had projected. It did have an impact on the yields, because government is going to borrow less, which means demand for funds are going to be lower, which means interest rates would have a favorable impact, and yield on government securities would also have would also fall. That is a result of unanticipated announcements, but market generally anticipates these announcements. When we say unanticipated, it means it was not declared originally by the government at the start of the year. Which is what I have said. If the market participants anticipate such a move by the government, long-term bond yields will go up. If at the same time, and this is the point you have to bear in mind, the government suddenly announces that there is going to be an increase in its borrowing requirements, the market is caught off guard, and if there is a liquidity crunch in the financial system at that time, the short-term interest rates would also go up. The long-term yields went up because the government said we are going to borrow more. So the 10-year yields went up because the government is borrowing more. But at the time the government says we are going to borrow more, resources have to be mobilized by those who want to bid in that auction for government securities. But if there is a liquidity crunch in the short-term market at that time in that financial system, you will find that short-term rates also go up. I hope I have answered that question to your satisfaction. Souvik has another question. What impact does an appreciation or depreciation of a country's currency have on its bond market? In other words, what actions in the foreign exchange market would impact the bond market? Now, let us try and answer that question in some detail. Interest rates and exchange rates in any country are in many ways correlated. In fact, there is a very profound theory in the world of finance called the interest rate parity theorem, which some of you might be already be aware of. I deal with these concepts in a subsequent course in this program titled Foreign Exchange Markets, Concepts, Instruments, Risks and Derivatives. If I remember correctly, that's going to start end of November. Am I correct, Ranjita? It will start end of November. Souvik, you get a very detailed answer to your question once you sign up and start going through that program. Now, since you raised the question, let me answer them in as non-theoretically as possible. Here are some possible scenarios. Say imports in a country is significantly more than exports. It could be because the country's economy is doing well, therefore they have to import more, or if it's an oil importing country, oil prices per barrel went up in US dollars, and therefore they have to, it's going to cost them more to import the same amount of oil, so the import costs go up significantly more than the exports. Now, when that happens, a lot of the importers Now remember what happens in a stable state. If exports equal to imports, and that's what we call the balance of trade, we don't have a problem. But if imports suddenly go up when exports remain constant, or imports remain constant, exports go down, or a double whammy, imports go up and exports could fall. All three possibilities exist. Now what does this do? Because the country is importing more than it is exporting, the importers will go and want to raise foreign currency. So they will go to the banks in that country and say, right, debit my local currency account and give me the foreign currency. Now what this does is they are selling the local currency to buy the foreign currency, which means the local currency would A, weaken with respect to that foreign currency, and B, there will be surplus liquidity in the local currency in that country. So that will be the outcome. Now how does that affect the interest rate market? When liquidity goes up, there is more money in the system, interest rates would fall. When interest rates would fall, it will have an impact on the bond yields, because yields will also fall. When yields fall, bond prices would go up. So that is how the linkage is indirect. No well run government, no well run central bank would allow this to happen unabated. Now what do? They would intervene to sterilize the system. Now what is sterilizing the system? Remember what the rest of the markets are doing? They are selling, all the importers selling the local currency, buying the foreign currency, selling the local currency, buying the foreign currency. That is what caused the problem that I just explained to you. So what do? What does the government do? What does the central bank of the country do? Do the exact opposite, but it is called sterilization, right? Now I will discuss these in great detail, as I said already, in the course on foreign exchange markets. But so this was the short answer to your question, what is the linkage between foreign exchange markets and bond markets? If exports are much more than the imports, the exact opposite would happen, because there is a shortage of domestic currency. All the exporters are realizing their proceeds in the foreign currency. They will want to sell the foreign currency and buy the local currency, sell the foreign currency, buy the local currency. Demand for local currency goes up, which means the interest rates, which is the price of money, the interest rates on the local currency would go up. When the interest rates on the local currency go up, it will have a knock-on effect on the yield on debt securities like government bonds, government securities and corporate bonds, and when that goes up, the price of the bonds will fall. So that is the kind of linkage between the foreign exchange market and the bond market. There is an added variable in emerging markets. You know, the inflow and outflow of currency happens not just through exports and imports, but also through monies brought in by foreign investors, either as foreign direct investment to invest in real assets, plant machinery, etc. in the target country, or they just bring the money in for a short period in time to invest in the equity markets or other asset classes in that emerging country. So when there is a lot of inflow of foreign currency into that country, because money is brought in by foreign investors, they are bringing in the foreign currency and converting it into the local currency, which means the demand for the local currency goes up, and it works exactly the same way as I explained for the exports context. Now if the economy, that emerging economy, faces headwinds and its performance falls, these foreign investors will want to take their money and go out. So they are selling their local investments, their investments in local currency, turn it into foreign currency and take it abroad, which means it functions like imports, and the ramifications in the interest rate market and the bond market would be identical to what would happen when imports go up substantially. As a third question that Souvik had asked, how has the bond market behaved in Venezuela given its deteriorating economic condition? Wow, this is a fantastic question, and I say that because here is the answer. Bonds issued by the government of Venezuela were at one time, and I think even today it is very close to that, trading at 30% of face value. So let us assume the currency of Venezuela is pesos. I don't know what the currency is, to be honest, because Venezuela, in my view, is a very dangerous country to be having any trading relationship with right now. So let's assume it is pesos. When the Venezuelan peso face value 100 pesos for one government security, today it is trading at 30 pesos. That means its price is at a 70% discount. Now that is a very perilous situation for any country to be. Government of Venezuela, and we have learned this before, government is the most risk-free borrower in a country. Now if the government is not able to raise resources because its bonds are trading at a 70% discount, can you imagine the plight of the corporate borrowers in that country? It's awful. That's the situation they are caught in. Now the problem in Venezuela is, as I've said, you can see on that slide, is an eclectic mix of domestic political instability. Those of you who have been tracking Venezuela for a few years now would know they had a very assertive, almost dictatorial leader in the name of Hugo Chavez. Now Venezuela is very rich in oil. So Hugo Chavez built up huge reserves when oil prices were just going northwards, and this happened during the 90s and the early part of this century. So Venezuela became incredibly rich. But because it was a dictatorship under Hugo Chavez, they were not invested wisely. In fact, Hugo Chavez in some sense was an egomaniac. So what he actually did, forgive my using the word, but I think that's what he was. He used all those dollar revenues that they got by exporting crude oil to invest them in real estate in the United States. So even today you go to New York, a lot of the big buildings are owned by the government of Venezuela or the wealthy people of Venezuela. Now that is a bad investment, because real estate, as you and I know, is the most volatile form of investment that you can come across. So that's one problem. Today the US government is saying, right, if you act tough, we're going to take possession of all of those real estate assets that you have in our country. So they're caught between a rock and a hard place. Point number two, Hugo Chavez died, the new government came, and the new boss man of that country is not able to manage the domestic politics. So there is a political turmoil domestically in Venezuela. And the third is the macroeconomic management is very poor. Those of you who have done the first course, we did talk about interest rates and so on, where we said real interest rates plus expected inflation is the nominal interest rates. In Venezuela, inflation has gone through the roof. Therefore, the nominal interest rates are very high, which also explains why the bond yields are very high, and therefore the bonds are trading at a huge discount of 70%. This fundamentally is a problem in Venezuela. This is not the first time they are going through this. They have gone through this a few decades ago. Their currency was devalued, they came out of it, and boy, they have gone into the same mess one more time. Now those of you who are interested in knowing more about this, you can see a web link at the bottom of that slide. If you go into that web link, you will get a very, very lucid analysis of what actually has happened in the recent past in Venezuela and what could happen in Venezuela. Now as students of finance, we would find this fascinating. I mean, very rarely does it happen that the bonds issued by the government of a country is trading at a 70% discount. That one sentence will tell you the dire straits that economy is in. I hope I have answered that question, Savik. And the third question you've asked is, what is the relationship between money and debt markets with other commodities, gold and silver? Now, I'll deal more with gold because the silver market is not as dominant in the commodity space as is the gold market. And the world tracks gold with debt markets and a couple of other markets that I will talk about in a minute. Gold is considered a natural hedge when prices of other asset classes such as equity, stock, bonds, not binds, bonds, and real estate go topsy-turvy. In other words, when the equity markets are going under the floor, when the bond yields are going through the roof and therefore bond prices are falling, these things do happen in every country, mostly for short periods in time, but if the country's economy is mismanaged, that could last for much longer. It is at such times that a lot of smart investors will want to move into gold, because gold is always a hedge, and gold prices are not determined by what happens in that country. Gold prices are determined internationally, just like oil prices are determined internationally. Whereas equity, stock prices, bond prices, real estate prices, all of these prices of these asset classes are driven by domestic realities. So you will always do well to keep gold as a hedge. And there is a negative relationship between gold price and interest rates. In other words, when interest rates rise or they are about to rise, if you are holding bonds, you know that because the yields are going to fall, you are going to lose money by holding the bonds. So when you get the first whiff of it, sell the bonds, raise your money, go and put it in gold. Smart investors do that. They stay invested in gold until the interest rate cycle takes a U-turn, interest rates start to fall, they will liquidate the gold position, go back into the bonds and buy them when the interest rates are at its peak, because that is when he is able to buy it at the lowest price. So that is the relationship between the gold market and the bond market. A question you haven't asked, Souvik, I am going to address this on my own, which is the relationship between gold and oil. Remember, both are commodities. In the previous illustration that we saw, equity, stocks, bonds, these are not commodities, they are financial assets. Gold and crude oil are traded in the commodity market, not in the equity market or the bond market. They are a different market altogether, and the dynamics of that market is very different. Researchers have found, and I have done some work myself in this area, price of gold and price of oil are hugely correlated. What I have on screen now for your benefit is the graph showing gold and Brent crude oil for an extended period from 1987 to 2012. That is a very long period, all right, 25 years. Look at how the two prices have moved. The brown line and the yellow line. The brown line is Brent crude, the yellow line is gold. You see the correlation between the two? So, Souvik, the reason why I brought this up, although you have not specifically raised this question, is the correlation between crude oil and gold prices is virtually close to 1 correlation coefficient. The relationship between gold and financial asset markets like bonds, they are also correlated, but nowhere as closely correlated as gold and crude oil. All right. So that is the point I wanted to make. So the graph is there, and those of you who are interested in knowing more about this, I have given a web link, go and read it. It makes fascinating reading, and this is a piece of knowledge that many people in the world, including traders in financial markets, are not aware of. That is why I thought I will just bring it in this webinar. Now I move on to another learner, Rashid. Rashid, your mail ID says Rashid IISC. I presume IISC stands for Indian Institute of Science. I am curious to know whether you are a student of pure and applied sciences or you are a student of finance. Anyway, if you are a pure or applied science student or an engineering student and you are interested in finance, I am delighted. But if you are a student of finance, well, I am sure you learn more than what you already know by participating in this suite of 5 courses. The question you have asked is, please explain what exactly happened in the recent IL and FS crisis and how that led to a cash crunch for NBFC and mutual funds. Now, for the benefit of those from outside India who have logged into this webinar, some of those phrases might not make sense. So, let me, for your benefit, for the benefit of the non-Indian learners who have logged into this webinar or would probably be seeing this webinar offline at a later point in time, IL and FS stands for Infrastructure Leasing and Financial Services. That is the name of a company incorporated in India. Now, recently they went into a huge crisis. They owe the financial system. They have borrowed well over $10 billion US. In Indian rupee terms, it is 91,000 crores. That is a huge amount of money for one institution, and they are on the verge of bankruptcy. Now, what led up to that company going into bankruptcy? What is the turmoil that it created in the market is haunting many of us in the Indian financial system. And one of the other learners, his email ID is Visracheat. It would be nice if you tell us what your name is at some point in time. Maybe if you are signed into this webinar, you could just send a response saying your actual name. He writes, thanks Rashid for posting this question. Some of the reports I read after the crisis at IL and FS came to highlight the point that asset liability maturity mismatch in the balance sheet of the organization, long maturity of assets and short maturity of liabilities. Remember, we have learnt about duration in the course that is just concluding today. Exactly the problem. Liabilities are short duration, assets are long duration. Now, he goes on to say, which eventually cascaded to default on the commercial paper borrowings by IL and FS. Now, let me explain a bit further on the point that he has so aptly pointed out. This institution is one of the shadow banks in India, very similar to several of the investment banks and hedge funds that caused the 2008 crisis in the United States. Fortunately, we do not have so many shadow institutions. This is in this country, in India, this is probably the only one of that size. Now, what went wrong? This company got itself into infrastructure projects, construction of power plants, roads, long gestation projects, where your revenues have to be, your costs have to be incurred today, your revenues are going to come several years into the future. Now, that needs deep pockets and a staying power. In order for the company to be able to fund that kind of long-term projects, they need to raise long-term resources. So, if you are investing in a project that is 15 years life, because the loans are going to be repaid in 15 years, you bet that is on the asset side of ILFS balance sheet. They need to raise resources on the liability side, which is at least 10 to 15 years. Now, they did raise resources of a shorter duration, not matching with the duration of the assets, but when those liabilities came up for maturity and rollover, the fortunes of the company had turned bad, and therefore nobody was willing to give them money for 5 years, 10 years, 15 years. But the paradox of finance is every day assets must be equal to liabilities. When you close the business, your assets must be equal to liabilities. So, the only way out for them was to borrow short term, 90-day commercial paper. They just issued commercial paper. So, if you look at the balance sheet, they have got loans for 10 years, 15 years, and they got commercial paper for 90 days on the liability side. That is what we call an asset liability mismatch, which is exactly what Vizrachit has pointed out in his observation. Now, how did this have a cascading effect? Mutual funds and non-banking finance companies in this country, non-banking finance companies are very similar to the savings and loans institutions in the United States. They are financial intermediaries, but they are not as rigidly regulated, nor are they as big in size. Now, mutual funds, all of you know what are mutual funds. Mutual funds were flushed with cash because a lot of investors in mutual funds had put their money in mutual funds, and the mutual funds didn't think it was the right time for them to invest it in equity stocks. So what do? They invest in short-term paper, commercial paper, 90 days. They invested, mutual funds invested the money in ILF, commercial paper issued by ILFS. Non-banking finance companies, credit offtake was very poor. They were also flushed with funds, so they said, let us go and invest in this commercial paper. Why did the mutual funds and NBFCs choose commercial paper for 90 days? Because they said it is short term and therefore the risk is very low. Now, we have seen this before, right, in term structure of interest rates in the first course on banking and financial intermediation. Shorter the tenor, lower the interest rates and lower the risks. So, a commercial paper intrinsically, because it is short term, will command a lower discount rate and it is perceived to be less risky. But where did the party go wrong? At the end of the 90 days, when the commercial paper was to mature and it had to be rolled over or it had to be repaid, ILFS did not have the resources to repay the commercial paper. So there was no way they were going to issue fresh commercial paper, because who is going to buy them? You know, if you had bought the first round of the commercial paper and you suddenly realize they are not going to repay it, you will never invest in the next tranche of commercial paper that institution is going to issue. Now, which means they are caught in a bind, and suddenly the institution found itself not being able to raise resources on the liability side of its balance sheet. Now, that is a crisis. There is also the role of the credit rating agencies, the same learner has said, which rated these commercial papers highly until very recently, thereby creating information asymmetry for the creditors. So, when ILFS issued this commercial paper, credit rating agencies came along and said, it is all AAA, no problem. Now, obviously, the credit rating agencies did not discharge their fiduciary responsibility correctly. If they had looked at the financials of ILFS and say they saw the asset liability mismatch, they should not have rated that paper AAA. Now, if you look at the pattern of crisis all over the world, this is exactly how it happens. This is exactly what happened in the 2008 crisis. The scale was much bigger and it was global. Here it was limited to the market in one country, in this case India. Short-term liabilities supporting long-term assets, issue commercial paper to raise short-term liabilities, credit rating agencies gave it a AAA. So, first round went through, and when things started to go bad, the credit rating agency will come up and say, sorry, it is not AAA anymore, it is CCC. And therefore, investors would not subscribe to this commercial paper. So, institution, in this case the ILFS, is caught in a bind, and it has a serious problem where it is not able to raise the required resources on the liability side. That is what he is alluding to. There is also the role of credit rating agencies, which rated this commercial paper highly until very recently, thereby creating information asymmetry for the creditors of this commercial paper, that means those who bought this commercial paper. I find it somewhat similar, very relevant observation, to the 2008 financial crisis. I also request the course staff, that includes me, to provide a more in-depth analysis. That is exactly what I am trying to do now. Your answer is absolutely spot on, and here are some more inputs from my side. The ILFS crisis in the Indian financial system is in many ways similar in flavor to the 2008 global financial crisis, but nowhere comparable in scale, complexity and cross-border devastation as a global financial crisis of 2008, because it was a crisis in the mortgage-backed securities market in the United States, which is one of the largest markets in the world, and there were people buying into that paper from several countries across the world, several banks. So, it took down several banks across the world. The architecture and the genesis of the problem is exactly the same. The only difference is ILFS balance sheet is only in Indian rupees and the investors in that institution were all Indian origin. Therefore, the crisis was limited only to India, number one. Number two, there were no, ILFS is nowhere near the size of Lehman. In other words, ILFS as a percentage of the Indian financial system is far smaller than Lehman Brothers as a percentage of the US financial system. So, because the institution was not so systemically important, ILFS is not so systemically important, I believe the government of this country and the central bank of this country will be able to tide over. In fact, some corrective actions have already been taken. As I said before, all financial crises witnessed over the last several decades would have exactly the same flavor, no change. Asset liability mismatch, credit rating agencies come in too late, and they try to lock the stable after the horse has bolted, as they say in English. And as the markets hurtled towards the crisis, that is when the credit rating agencies would come and downgrade you. What were they doing until that time? This is a question that has not been answered. There is a fundamental corporate governance issue with credit rating agencies which I would like to mention in this webinar. The people who pay the credit rating agencies to credit rate are the institutions themselves. So, if I am running a bank and I want to be credit rated, I pay the credit rating agencies to credit rate me. Now, do you see a conflict of interest there? The credit rating agency has a vested interest to give me a good rating, because if they gave me a bad rating, next time around when I want my bank rated, I am not going to go back to them. So, I am going to choose that credit rating agency which will give me a favorable rating. That is a fundamental corporate governance issue which has not been resolved globally. The only way we can resolve this is to create a fund where all entities in the country, all institutions who want to be credit rated should contribute to that fund based on a percentage of their balance sheet, and a nodal agency like the central bank of the country should decide which credit rating agency will credit rate which institution, so that there is a certain randomness in that process. Now, it is a very, as we say in slang, a very cuckoo-chku relationship between the credit rating agencies and the entities being credit rated. So, there is always a moral hazard that to get repeat business, the entity being credit rated will always be given a AAA rating. I hope I was able to articulate the fallacy in the structure of payments to credit rating agencies and why we keep running into this problem again and again. There is those of you who are interested to know more about this problem, the Week magazine of the 25th of September has a fabulous article. The headline reads, "Explained what is IL&FS crisis and how bad it is?" It explains this crisis in great detail. I have given you the web link on that slide. You can go ahead and look for it, and you will know everything that you want to know about this crisis. It is actually a textbook case of how a crisis can be created. Someday I will turn it, someday in the very near future, I would turn it as a case study which we would use in the classroom. In fact, issues like this and the causes, the consequences and lessons learned with specific reference to the global financial crisis of 2008, we deal with it in great detail in the last course in this professional certificate program that is scheduled to go live on the end of December. So, Merry Christmas, Happy New Year, and you have logged into this program to understand how the global meltdown of 2008 happened and all the nuances and intricacies. Now, I do this at the very last course in this professional certificate program because all the theory you need to learn, you would have learned through the first 4 courses. So, this is the 5th course is a culmination of all that learning on, if you know the theory, you know where things are going wrong, when they go wrong. So, that is the idea. That is why it is in course number 5 in this suite, in this compendium of courses. The other point that was mentioned were the perils of asset liability mismatch. I am sure most of you who have logged on to this course would have done the previous course which we just concluded a few days ago. Title is Banking and Financial Intermediation, Concepts, Instruments, Risks and Derivatives. We have devoted a huge chunk of time in that course to deal with problems of asset liability mismatch. I would urge you to go and revisit that course. In fact, it is now running in self-paced mode. So, those of you who have not gone through the first course, do go back to it. And let me say this with all the goodness of my heart, there is a certain sequence in which we have put together this course, course 1, 2, 3, 4, 5. The first course deals with banking, financial intermediation and all the risks associated with it. Course 2 which we are doing now is money markets and debt markets. The third course is equity stock markets, the fourth course is foreign exchange markets, and the fifth course is all the special topics that includes things like value at risk, stress testing, Basel III, what causes crises and so on and so forth. So, although there are 5 discrete courses, if you want to get the most benefit out of it, I would strongly urge you to go through all 5 of them in that sequence. Okay? Shweta has raised a question. Hello sir, I am not able to come to the correct answer using annuity formula. Can you please explain it again? And my answer to that is, Shweta, the annuity theory is a lot older than me. The annuity formula came into existence several decades ago. It can't be wrong. So, there is something not correct in the way you are doing the computation. So, my suggestion is, obviously the numbers you are plugging in, there is an error. If you want to sort it out, just write an email to us with the full details, and either I or one of our research assistants will get back to you identifying where is the error that you have made. So, I am not going to spend more time trying to explain that concept, which is the annuity formula is rather basic. Nobody can go wrong with that. Okay? So, must be something wrong with the numbers that you are plugging into the annuity formula. So, do send us an email and we will have your question sorted out. The second question is a more interesting one that you have raised, Shweta. Why financial institutions use modified duration to calculate expected price of bonds when they could do so by using the present value formula? Now, sitting in the comfort of your home or office and watching this duration videos and time value of money formula, it is a very right question for you to ask. But put yourself in a dealing room where prices of assets are changing literally by the second. Imagine you got a 30-year bond, residual maturity 30 years. How are you going to use the present value formula, because you have to do 30 computations plus the 31st computation, which is the present value of the face value of the bond. You do not have the time to do that. The market should have moved by maybe 20 basis points in the time that you do this calculation. That is the reason why we do not use present value formula in the real world of business. The theory is very important, because if you did not understand time value of money and how to compute present value of future cash flows, we could never have graduated doing Macaulay duration and modified duration, because they are derived from that basic theory. Why were those basic theories taken up into advanced theories like modified duration? Because that is easy to compute, and modified duration is what traders use very quickly. In fact, it is a very nice number. You just tell that number, you know a lot about that bond, which is what you try to explain in those videos, right. So in the world of business, in the treasuries, in the dealing rooms, they don't talk about present value. They only talk about Macaulay duration, modified duration, depending on the context in which they have to use it. All right. I hope that's clear. The theory is very sound, time value of money, computing present value, but it's too cumbersome when you are working in a hot seat where prices are changing by the minute. Modified duration works out much better, because remember, most of the time when you're sitting as a dealer, and I've done it myself, you're just trying to find out for a 1 basis point change in interest rates, what is the change in the price of the bond? The duration formula helps you arrive at that. That's why it's useful. To do the same thing using present value, you'll have to write a spreadsheet, you'll have to do a spreadsheet. It just won't work. That's the answer to your question. I hope it is clarified. Otherwise, do write back to us and we will take your question on the discussion board or on an email. Here is the question from Vizrachit. I mean, he has played the dual role. Earlier he gave answers to a question somebody else raised, Rashid raised, and now he has raised a question himself. I have a query regarding the convexity formula. Is the formula iterative? That is, after correcting for convexity one time, we get a value of the bond that is close to the value calculated using the present value method. What you have said thus far is absolutely correct. If we apply the convexity formula again to the new value of the bond thus obtained, would we meet a value that is closer to the estimate? Look, convexity is not used for any iterative calculations. It is basically to explain that for long duration bonds, the present value formula prompts you to think it's linear, but actually it's not linear. So if you want to arrive at the accurate price of a bond using modified duration, you use convexity, and that computation is a point in time. Please remember, I am a trader sitting here right now and I want to decide whether to go and buy a bond or sell a bond or take a position in that bond. Modified duration is easy for me to do, convexity computation is easy for me to do. I arrive at the price and I take a decision, right? 10 minutes later, if I want to sell the same bond, I would go through the same modified duration convexity computation. The video that we have produced is a detailed spreadsheet explanation of the theory as to how you can take modified duration, which presupposes a linear relationship, and turn it into a convex relationship, which is actually what the present value formula gives you. So it is always a point in time calculation, and it is not iterative, it is repeated every time. So you bought a bond in the morning, you would have gone through this calculation, modified duration convexity. You want to sell the same bond in the evening, you go through the modified duration convexity. If you are sitting in a dealing room, you do not talk present value at all. You only talk modified duration or Macaulay duration in some situations and convexity. I hope I have answered that question to your satisfaction. Next question is, why is it difficult to estimate interest rate change beyond 1 year? Can we not infer it from the yield curve? Now this is not an unusual question for people to ask. My answer is the following. Yield curve is produced every day based on the previous day's closing prices. Go and look up again the yield curve video. Was it in the first course or the second course, yield curve? In the second course. So there is a video on yield curve. Yield curve is arrived at, it's an interpolation based on the closing interest rates for bonds with varying maturities. The data is taken and it's interpolated and you get the yield curve. That yield curve is based on data as of the previous evening closing prices and closing yields. Come tomorrow morning, there will be a new yield curve which will be based on the closing prices of bonds today evening. So the life of an yield curve is only 1 day. Now how can you use that to estimate interest rate beyond 1 year. So, yield curve is not the solution. In fact, it is very difficult, and that is the answer to this question, to predict with any degree of theoretical accuracy what the interest rate is going to be 1 year from now. The reason for that is macroeconomic exogenous variables are so many that you will not be able to make a realistic prediction even for 1 year, certainly not beyond 1 year. Now, you might ask, then how come we have yields for 10 years? Now, that is completely market driven. For example, you buy 10-year bonds in the United States, the yields will vary depending on a sigma of all of those macroeconomic variables, right? And the price is discovered based on the 10-year yield. There is not that much of paper that is traded in the 1 year duration. So, if you get a price for 1 year based on the yield curve, that is valid as of yesterday evening. If the yield curve is steady over a period of several months, then you can take that yield curve rate, which will be consistent day after day after day, as the interest rate for 1 year. Having said that, in markets, most markets only deal in the very short term interest rates and the 90-day interest rates and possibly the 10-year interest rates. These are the three benchmark rates that is used in most markets. Overnight call money rates, that is 1 day interest rate, the repo rate or the repurchase obligations rate, which is usually 1 fortnight. Then you have the 90-day T-bills, which will give you the discount rate for 90 days risk free, or commercial paper, which will give you the 90-day interest rate. But there are not too many paper that is traded for 1 year. After the 90-day, 180 days, straight away it goes to 10 years. So, there is no market discovery of those interest rates in the period between the 180-day and the 10-year bond yields. So, you can get approximations. If you are okay with the marginal error for whatever purpose you want the 1 year rate, you can do that. If you are asking this question in the context of the duration gap analysis that I talked about, where we take all assets and liabilities up to 1 year maturity and let us work through them. We take the 1 year and not beyond 1 year because we do not know how much the interest rates are going to change 1 year from now. There could be some forward rates, but those are estimates based on some variables. For example, today the US dollar interest rate and the Chinese yuan interest rates and the exchange rates are at a certain level. Now, they changed because of the friction that we have seen between the United States and China, the so called trade war. Nobody knows which way it is going to pan out. So, if you are looking at if that standoff between the United States and China is a serious issue which is going to impact interest rates and exchange rates, can you predict 1 year from now what the outcome is going to be, and therefore what will be the impact on the interest rate and exchange rate on the Chinese yuan? We do not know. Can you predict it for the next 1 week? Yes, more accurately. Can you predict it for 90 days? Yes, less accurately. 1 year, anybody's guess. So, there are several macroeconomic variables that are very difficult to predict beyond a short time frame, and that is why any assessment of interest rates for the medium term to long term your guess is as good as mine, right. Economists battle with this problem all the time, but they get it wrong most of the time too. Under what macroeconomic circumstances would we have a hockey stick yield curve? The same learner has asked this question, and I have for you a graph. Now, this is the shift in the yield curve between 2007 and 2010 for the US dollar and the acknowledgement, the source is acknowledged in that slide. Now, you see the blue line, that is a hockey stick. And what are those three lines? The blue line at the top
is 07 January, the brown line is 07 January 08. The first line is January 07, the second line is January 08, and the third line is January 10. Now, the bottommost line, which is as of January 07, remember, was getting very close to the crisis of 2008. So, somewhere along the line, market wisdom was, in the short term there is no change in interest rates. So, up to 1 year, overnight to 1 year, the interest rate was virtually the same as on 7th January 2007. Remember, yield curve is only for 1 day. So, this data is as of 7th January 2007. Up to 1 year rates, overnight to 1 year rate constant. Rates beyond that is exponential. That is a hockey stick. But you move 1 year further forward, the same economy, the brown line in the middle, shows a different kind of hockey stick actually, if you look at it, because that is when the crisis was full blown. It will be very close to the crisis. The crisis actually happened in September of that year. So, January of that year, you do notice a very interesting curve, and what that tells you is, in the very short term, interest rates are very high, but in the medium term, the interest rate is actually falling. That means, up to 1 month, interest rates are higher than interest rates for 1 year. Can you imagine this precarious situation, where 1 month interest rates are higher than 1 year interest rates? Now, this tells you the lack of confidence in that market. There is surplus liquidity in 1 year, there is a shortage of liquidity for 1 month, because everybody is running into the short term market and trying to borrow. So, if you are a borrower in January 2008, you would not borrow long term, you would not borrow medium term, you would only borrow short term, because you do not know whether your company is going to survive the year, because the economy is heading up for a huge tsunami. So, you borrow short term. Liquidity for the short term money goes up, and therefore, the interest rates have gone up, whereas in the medium term it has fallen, and the long term story of the US financial system is still intact. So, 10-year bond yields, in all those 3 curves, if you notice, the 10-year bond yields have not changed. That is the point I am trying to make. So, all the gyrations are in the short term, they are not in the long term. I hope you understand the point I am trying to make. And when you went to January 2010, this is well after the crisis, the yield curve is almost flat. There is hardly a difference between the overnight borrowing rate, the 3 months borrowing rate, the 1 year borrowing rate, and the 10-year yields. They are all the same. That is a flat yield curve. So, you see, over a period of 2 years, a period of enormous macroeconomic volatility in the US system, in fact, it is true in the global system, preceding the 2008 crisis, succeeding the 2008 crisis, you see how the yield curve was reflecting the larger sentiments on interest rates in the market. It went from a hockey stick, which is more like a golf stick. It went into a hockey stick, which is a kind of a U shape, and then it became flat, all in a period of 2 years. I thought I will take this example to answer your question, what is a hockey stick yield curve? I hope I have answered that question. If you still have some doubts, do post it on the discussion board. We will be happy to take your question. Now, here is Evangelos. Is it possible, and where someone could monitor the repo market for a specific asset, is it useful and practical to make a time series on these observations, and if yes, how can we interpret it as early signs in the direction of that asset? Well, the answer to that question is no, because remember, in a repo market, any asset, it is a money market actually. Any asset that you use is only used as a collateral. Now, you can't use the pricing of collaterals as a basis to draw any conclusions that will be relevant to the financial market. In a repo market, the collaterals, that is what you are talking about. When you say monitor the repo market for a specific asset, the answer is no. It's not possible. Repo market is part of the money market. The collaterals are longer term instruments from the debt market. You can't extrapolate the price of that debt paper. There is a separate market that operates for that long term debt paper. So, if you use government securities or 10-year corporate bonds as a collateral in the repo market to borrow for 14 days, the change in price in that corporate bond or that government security cannot be extrapolated based on the data in the repo market. It can only be extrapolated based on the realities that exist in that market for the 10-year bonds, corporate bond, or the 10-year government securities. Don't mix up the two. So, I think that was the last question. If you can stay for another couple of minutes, I was a little taken aback by some of you not understanding in the ungraded questions that we have between cash outflows and cash inflows. Do go and revisit it. We had given 5 options. 2 of them are items, 2 choices are cash outflows, and 3 choices are cash inflows. We asked 2 separate questions. From out of this list of 5, identify the ones that are cash outflows. And later there is another question which says, out of the same 5, identify the ones that are cash inflows. Now, to my mind, those were first principle questions. Everybody should have got it right. I was a little perturbed that several of you got it wrong. Cash outflow for any entity, a company for example. Examples of cash outflow is when you are repaying a loan, when you are honoring your payables commitments to your suppliers, you have to pay interest to the bank. These are examples of cash outflows. Cash inflows would be when you have sold the goods and you have realized the money, your buyers pay you, that is a cash inflow. So, cash inflows is where money comes into the system, into the firm. Cash outflows is where money goes out of the system. There could be items on the liability side which are generally cash outflows, and on the asset side when they are realized they are cash inflows. As an instructor of fairly advanced courses of the type we are going through now, if you do not get answers to these basic questions correct, I tend to get worried. So, please go back and revisit some of these basic concepts, because if you haven't got those basic concepts right, you can never build on it as we go forward. Now, this feedback obviously does not apply to some of the advanced learners in these courses, but some of you who may not have the same level of prior knowledge, I would urge you strongly to bring yourself up to speed, because as we go along out of the 5 courses, in terms of the theoretical understanding, they get more and more time consuming, and I would not say difficult, but you will have to apply yourself to be able to learn them. And if you did not know the first principles, you would never be able to work on them. Okay? Any questions have been posted? I will just look at the questions that you posted and I will try and answer them. Okay, this is a very India specific question from the way it is worded, but it is a universal fact. The question is from a learner by name Maruti. Why Indian airlines in India are expanding their fleet and routes despite losses? I am particularly interested in an airline called SpiceJet. What is the future scenario of airlines in India? Replace the word India with all countries in the world, it will be the same truth. Why are airlines all over the world expanding their fleet and routes despite losses? I am particularly interested in, you can name any airline that you know in any country. What is the future scenario of airlines around the world? It's a very fascinating question. You know, airline industry is perhaps one of the most capital intensive industries in the world. You want to buy a motor car, you can buy a motor car for $10,000. If you are a super rich guy, you can buy a motor car for $250,000, maybe $500,000 if a car is made of gold, maybe, but that is the maximum. But you buy airplanes by the dozens, that is what an airline company does. Your assets are worth tens of billions of dollars.
The big component of operating costs for an airline is aviation fuel. So, the big risk you run is when oil prices go up, the airline companies' operating costs would go up in the same proportion. And what that does is they will have to up the prices of tickets in order to maintain their margins. When they up the prices of tickets, and God forbid, because of the high oil prices and whatever else may be the reason, inflation goes up, and as a result interest rates go up, and you will find as a consequence profitability of companies is falling, because now they have to pay a higher interest burden. Any company, you may be working for Ford Motors, they have taken loans from banks, inflation in the country goes up, interest rate therefore goes up. We have learned that in the Fisher equation, which means they have to pay a higher interest to the bank for the loans they have taken, which means their profits are squeezed. And when this happens, and I am sure it happens in the company where you work, when profits fall, the first advisory to the employee is cut down on your travel costs. Now, look at it from an airline's perspective. On the one hand, fuel prices are rising, therefore the costs are rising. On the other hand, advisory to companies, people postpone holidays, revenue falls. So, you got a fall in revenue situation, you got a rising cost situation, your margins are under enormous pressure. Now, if you recall your first principles of accounting, when your gross margins are squeezed, you might not make enough money even to pay the interest on the loan that you have taken. In an airline company, the loan component is always very high, because they are asset heavy and therefore they have to borrow hugely. The load factor falls, their revenues are lower, cost is gone up. Remember, you fly an airline with 50 passengers or 300 passengers, full occupancy 300 passengers, low occupancy 50 passengers. Your operating cost comes down only by 10%, but your revenue has come down to 16%. That is where you start booking losses. The interest burden remains constant, therefore you usually run into a loss situation. If you talk to airline company executives, they would tell you markets when they expand, we have to get in and increase our market share. How do you increase your market share? By buying more airplanes or leasing more airplanes, and 1 year later it just falls off, you are in trouble. We have had airlines like Kingfisher which went out of business because of the 2008 crisis. Oil prices went up to $120 a barrel, companies' profits fell, advisory to everybody, families did not go on holidays, advisories to all employees, do not travel unless it is absolutely necessary, do your business over Skype. The airline went into the red in no time. Several airlines went into the red at that time. So, what is happening to the airline you have spotted, SpiceJet? Partly the problem is they have expanded too fast. In fact, in an India context I can tell you, you read today's paper, it says Indigo, which is another low cost carrier which is considered to be extremely cost efficient and very revenue driven, they have posted a loss of over $100 million this quarter, just this quarter. So, it is happening to everybody. The lesson is, when you are in asset heavy industries, do not expand your capacity too fast, do not borrow too much, because when the winds turn against you, you will not make enough money to even repay the interest on the loan. Forget giving dividends to shareholders. That is what they are facing. They will tide it over. If they do not, some other airline will buy them out, or they will become part of history. Which way it will go? You got to wait and see. So, I would not be unusually worried about the situation with the airlines. I would be more worried about, in a very India centric context, I would be more worried about the national carrier called Air India. Their problems are very different. It is not because of macroeconomic circumstances, and I think those of you who are familiar with that market know what the issues are, so I will not go into that. So, the short answer to your question, Maruti, is yes, airline industry is full of volatilities on the profits,
on the ability to repay the interest, and they will never have a smooth ride. If you haven't understood what I said, compare this to an FMCG company that is making toilet soaps and toothpaste. Tell you what, or pharmaceutical companies. Whether the economy is doing well or not, if it is doing well, you need one kind of medicines to feel good and take care of your high blood sugar. If the economy is doing badly, your cardiac system is malfunctioning, therefore you need another kind of medicine to take care of your cardiac malfunction. Either way, if you are a pharmaceutical company, you are selling drugs. So you are impervious to recession in the economy. Take a fast moving consumer good company like Unilever. They produce toothpaste, they produce toilet soaps. Whether the economy is doing well or not, you get up in the morning, you need to brush your teeth, you need to have a shower, and you need a soap. You need to wash your clothes, you need a detergent. They are recession proof. But if the economy is turned turtle, your boss will tell you don't fly as often. Who gets hurt? Airline companies. That is the answer to your question. Intrinsically, airline companies are more risky. I hope I have answered that question. Yep. Anything else? Okay. We overshot. We started 15 minutes late. We have taken 1 hour and 6 minutes. I hope the session was useful. We will be uploading this on the course page, on the course, what is it called? Courseware. So those of you who are not able to sign in, you will be able to look it up on the courseware. Those of you who have signed in today, you can go and look it up again in the courseware. All right, wish you all the best and hope to see you in the next course that is starting tomorrow. And for the second course for which we have done the webinar today, it is the examination week where you have to do the end of course exam, and wish you all the best for that too. Good luck and God bless you all. Thank you.